Cryptocurrencies have had a wild 2021, with more people than ever before researching and getting involved in the space. In this video, I will give my opinion on whether crypto is a good investment and how a responsible, risk-averse investor can incorporate crypto into their diversified portfolio. A cryptocurrency is a digital asset secured by cryptography. This makes it pretty much impossible to counterfeit or double spend. There are many different cryptocurrencies, with hundreds being created each week. At the time of making this video, there are over 5,000 different coins or tokens out there. Investing in 99.9% of these coins would be a terrible idea. Anyone who knows what they're doing can make a new token in about 2 hours, which would be essentially worthless. It's very common for the creators of these worthless coins to pay influencers to promote them to get their fans to invest, pumping the value up to sell all their coins at a much higher price, causing the value to dump. So if you see a celebrity promoting a coin, be very, very cautious about investing any money. In this video, I will focus on the two biggest, most decentralized and most established coins, Bitcoin and Ethereum. Most people's crypto investment strategy revolves around one or both of these coins. People usually hear or find out about Bitcoin first, it's the household name, and then they find out about Ethereum after spending a bit of time researching, hitting the like button for the YouTube algorithm and being among the crypto community. Bitcoin is currently trading at around $36,000 per coin with a market cap of $670 billion. Ethereum is currently at around $2,200 per coin with a market cap of $260 billion. Despite the huge crash in the crypto market in mid-May, Bitcoin is still up 23% for the year and Ethereum is up 200%. So these coins have a great return. But how can investors value these coins? You'd only invest in an asset if you believe the future value to be greater than the current value to generate a positive return. Well, valuing crypto is very hard. As the governor of the Bank of England has said multiple times, crypto has no intrinsic value. This is different to investing in stocks, as they are real businesses with tangible assets behind them. Companies and stocks can be valued with a relatively high degree of confidence. You just forecast the future cash flow growth and price in any risk. But this cannot be done so simply with crypto. Many analysts have produced valuation methods with varying degrees of complexity and success. Quite a simple one that people often use is that Bitcoin is like digital gold, as it has become a digital store of value. Then, as the market cap of gold is around $10 trillion, Bitcoin's market cap will reach that, which means the price of Bitcoin will increase by approximately 14 or 15 times. Then furthermore, as Ethereum can essentially replace the current financial system of the world through its smart contract capabilities, its market cap could go even further than that. What I prefer though is that ultimately the value of a cryptocurrency can be boiled down to three factors: utility, scarcity, and perceived value. So using this, let's do a quick valuation analysis for Bitcoin and Ethereum. Starting with utility, which is how the coin or its blockchain can be used, Bitcoin, as I said earlier, is often seen as a store of value and as a currency. Upgrades to its utility do happen, but very infrequently, with the most recent being in 2017. An upgrade around the corner though, known as Taproot, will increase the utility by a fair amount as it will unlock the potential for smart contracts. With Ethereum, its utility is very high as its smart contract technology has been around for a long time, meaning very advanced decentralized applications and decentralized finance products have been made on the network. The Ethereum network is constantly being upgraded. An extensive group of extremely talented developers continuously improve the utility. The most prominent upgrade of all is currently happening right now with the merge to Ethereum 2.0, which takes Ethereum from using a proof-of-work consensus to a proof-of-stake consensus mechanism. This does get very complicated, so keeping it simple, the upgrade vastly increases the speed and number of transactions that the network can deal with, while reducing the transaction fees, and also significantly reducing its energy consumption. So, a massive increase in utility. Now, onto scarcity. Bitcoin has a capped supply of 21 million coins and a current supply of 18.7 million coins, with 1,800 new coins minted every day, so a 3.5% increase per year. Every 4 years, the amount of minted coins halves, known as a halving event, so it will become 900 new coins next. As more people adopt and use Bitcoin, you have more people wanting ownership of the number of coins available, which increases the scarcity. With Ethereum, there's a circulating supply of 116 million coins with unlimited supply. There's around 14,500 new coins minted every day, which is approximately a yearly 4.5% increase. However, once merged to proof of stake, this issuance rate will decrease significantly. Also, more significantly, in July 2021, so next month, EIP 1559 is going live, dubbed Ethereum Scarcity Engine. This is an upgrade to the Ethereum network that, among other things, causes the base transaction fee that a user pays to be burnt, meaning it is completely removed from the network rather than going to a miner. This means that during periods of high network usage, more Ethereum will be burnt than issued, so the circulating supply will actually be deflationary. This leads to a huge increase in scarcity. And lastly is perceived value, which drives the relative value of a cryptocurrency. This is what changes the most and is most challenging to predict and is arguably the most important factor. The perceived value will vary based on external factors like inflation fears or a large institution investing in crypto, such as when Tesla bought $1.5 billion of Bitcoin. Such events cause the perceived value to increase. Other internal events, such as rising utility and scarcity, will increase the perceived value too. Adverse events, such as threats of strict regulation and bugs, will cause the perceived value to decrease. The perceived value will drop fairly low during a bear market and then shoot very high in a bull market. For Bitcoin and Ethereum, as the network and scaling capabilities increase and more people research and start using the cryptos, I think the perceived value will increase, certainly in the long term. So for Ethereum and Bitcoin, all three valuation factors are increasing and looking good for the future. So I do think that there is a good chance that they will go up. However, crypto is still a speculative asset with a high amount of risk involved. This means that just going all in with a 100% crypto allocation in the portfolio is absolutely not what a risk-averse investor would do. A responsible long-term investor's goal is to maximize their risk-adjusted return. This is achieved through having a well-diversified portfolio of stocks, bonds, and commodities. A standard portfolio split would be something like 60% of assets in stocks, 25% in bonds, and 15% in commodities. We split our money across assets as during the economic cycle, there are 4 stages: slowdown, recession, recovery, and expansion. The assets perform differently during each step, with the stocks as the risk assets here and the bonds and commodities as the safe haven assets. We want assets that perform inversely to each other, as it means that during rough times the portfolio is not absolutely obliterated. It smooths out the bad times basically. So, how does crypto fit into this portfolio? Well, perhaps against intuition, crypto wouldn't be put alongside stocks in the risk assets category, but instead with bonds and commodities in the safe havens. A recent research paper by Dwight Mariana looking at Bitcoin and Ethereum during and leading up to the pandemic market shock concludes that both crypto assets show short-term safe haven characteristics, especially Ethereum. This is due to the inverse correlation to the general movement of the stock market, and then positive correlation to safe haven assets such as gold, although it is noted that the volatility of the crypto assets is higher than other assets. So, incorporating this, even for someone who isn't that bullish on crypto, for the sake of diversification, it starts to make sense to allocate a small part of the portfolio to crypto, replacing part of the commodity holding. An optimal starting allocation will be between 3 and 5%, so we'll say that the commodity holding comes down to 10% and crypto to 5%. According to a survey by the Financial Times, hedge funds expect to hold 7% of assets in crypto by 2026. Hedge funds are well aware of not only the risks but also the long-term potential. The more confident and bullish you are in crypto, the larger it makes sense for your allocation to be. However, I personally would cap the allocation to 20% for the most bullish investor out there who still wants a good diversification. Any more and you are getting too concentrated in a single asset, especially with the high levels of risk seen in crypto. So, for an investor extremely bullish on crypto, my hypothetical portfolio would be 60% stocks, 15% bonds, 5% commodities, and 20% crypto assets such as Bitcoin and Ethereum. So that's my answer. Crypto is a good investment and, depending on confidence, should make up between 3 to 20% of an investment portfolio. This is of course just my perspective and definitely not financial advice. Always do your own research. Hopefully the video has been helpful. Hit the subscribe button if you haven't already, and fingers crossed that your investments generate alpha.